Hello. Today we are going to look at the topic of inflation. Let's start by looking at what inflation is. Inflation is nothing more than a general and permanent rise in the price level. Thus, we cannot talk about inflation when the price of only one or two product rises temporarily. The consumer basket for the average customer is compiled by the Central Statistical Office, which continuously monitors price developments. As each person buys slightly different things, they have a different basket. Everyone will experience the impact of price increases differently. But inflation is not only in Hungary, it is everywhere where money is used. After all, it is nothing other than the deterioration of money. The rate of price level increases is different in every country and every year. Keeping it at a healthy level is a joint task of governments and central banks. According to the level of inflation, we distinguish between creeping, galloping and hyperinflation. In creeping inflation, prices rise by only a few percent a year, sometimes so much that it becomes so common that it is not even noticeable. This level is the best. It drives the economy a little but does not overburden it. But then there is the danger that if it is very low, it can turn into deflation, which can be damaging. When you have double-digit price increases, you have galloping inflation. An otherwise stable economy with reserves can cope with this, otherwise it can cause problems. At this level, people hold little amount of domestic money because of the rapid deterioration of the currency, and keep their assets either in some more stable foreign money, or invest it, or buy consumer durables with it. If inflation is not maintained or brought down to this level, there is a chance of hyperinflation. You may be familiar from textbooks with a hyperinflation, which could be the result of a combination of several effects reinforcing each other. In the case of hyperinflation, it is not uncommon for prices to rise by 100% on a monthly basis. So what costs €100 today will cost €200 next month, €400 the month after, €3,200 at the half-year mark and €204,800 by the end of the year. No economy can keep up with this. Let's look at the impact of inflation on the economy. If it is at an optimal level, the main task is to maintain it. This is usually referred to as the inflation target, as it leads to a stable, predictable economy. If the level is too high, there is a risk of hyperinflation. The wind of danger encourages people to accumulate things they don't need. Where there is demand, there will be supply, and this can be a self-exciting process. People will buy everything above their needs, creating a shortage. If it is replaced, usually at a higher price, so if people are willing to pay more and more for the reserves, it only drives prices higher. This in turn encourages people to buy more reserves, which leads to even higher prices. The main challenge then is to restore stability. Conversely, if the level of inflation is too low, there is a risk that it will spill over into deflation. That is a case where prices fall permanently. This sounds good at first hearing, but it is not a simple Black Friday, but a situation that could bring the economy to a standstill. After all, why buy anything today if you can get it cheaper next month? You are right about that, but companies can pay wages according to consumption, including the wages they pay for you. Another danger of too low inflation is the so-called liquidity trap. Since the public deficit is covered by loans on the one hand and government bonds on the other, it is of paramount importance to have the money to pay it off in arithmetic terms. In this case, they can collect more taxes, which puts a strain on the economy, or the debt can be inflated. In the latter case, the money needed is paid out in arithmetic terms, the purchasing value of which is eroded. If this fails, there is effectively insolvency. So then the main task is to stimulate the economy. Let's say a few words about the causes of inflation. The price of a product is basically determined by what price producers are willing to sell it for and what buyers are willing to pay for it. This is supply and demand. If I want to illustrate it, I can do it like this. The supply function is denoted S after its English name, and the demand function denoted with D, also after its English name. You can see that the higher the price of a product, the more sellers are willing to put their goods on the market, and the less buyers are willing to pay for them. The intersection of the two is the equilibrium price. But this price is not set in stone, it is constantly changing. Inflation can start from the supply side, so from producers. If the cost of producing a product increases, It is either incorporated into prices or production stops. After all, if they would produce at a loss, they would rather not produce. Such an increase could be if the price of raw materials increases, or even if they have to pay higher wages to their workers. If inflation can start from the producer's side, it can also start from the buyer's side. If people have easier access to money, they are more likely to buy better quality or more. After all, everyone wants to live better, so the extra money is not necessarily saved, but some of it is used. This may be the case if the bank makes it easier to lend at a low interest rate, or even if they have received a bigger pay rise. If they are willing to pay a higher price, it can be represented in this way. It can be clearly seen that if consumers are willing to pay more for something and even buy more, sellers will adjust their supply accordingly. They may produce more, but the higher price is guaranteed. No need to criticize them for this, you would do the same. The next cause of inflation is wage inflation. This reinforces both of the previous causes. Obviously, we are not talking about a single company raising wages, but if it is a mass phenomenon, which it will be, because when the firm across the road pays significantly more for the same job, the workers will work there. If firms have to pay higher wages, they will build the cost of this into their prices, so products will be more expensive. Since the workers are paid more, they can afford to buy more or more expensive goods. This in turn gives rise to price increases from the demand side. Thus, the effect of the wage increase is only short-lived. The next reason is inflationary expectations. This is not really a tangible reason. If the majority of sellers think that by the time they manage to sell their product, prices will have gone up anyway, they will adjust their prices accordingly. And that point in itself creates inflation. At the very beginning of the video, you could see that all countries are affected by the depreciation of money, but not to the same extent. Thus, if countries that are economically closely cooperating have lower inflation in one and higher inflation in another, then imported inflation is realized. This is most easily observed in countries with different currencies. Suppose you have a product that costs €1,000. When the exchange rate of the euro is 300 Hungarian forints per euro, it is offered in Hungary for 300,000 forints. If the forint weakens to say 350 forint per euro, you have to pay more forints for €1. Then you have to pay 350,000 forints for the same product in order to the manufacturer get the €1,000. The next factor is the amount of money in the economy. The money supply is controlled indirectly by the government and directly by the central bank. They can do this, for example, by changing the base rate or printing new money. You have no influence on this either as a consumer or if you are engaged in productive activity. At the very least, according to the law, you should leave the printing of money to the state. If the base rate is raised, it is more difficult to borrow, but the incentive to save increases. This means there will be less money to spend in the economy, and so they can cool it down a bit. Since interest on government bonds has to be paid, money has to be raised to do this. The state has the choice of going bankrupt or inflating the money. Usually the latter is chosen. This is why there is a striking similarity between the inflation level recorded by the Central Statistics Office and the graph of government bond interest rates. You can observe this not only in Hungary, but also in many other states. What is the impact of inflation on economic actors? Like everything else, inflation has winners and losers. So if you pay attention, you have the opportunity to decide which group you belong to. The winners of inflation are the borrowers. The real value of capital is reduced by inflation, making it somewhat easier to repay. Also, the winners are the investors. Because they do not hold their assets in cash, they are likely to have retained at least the purchase value when they convert their investment into cash. The losers of inflation are the lenders. Since they only get their money back later, they have to expect that the purchasing value of the amount will deteriorate in the meantime. The losers are the pensioners. Their pensions will be adjusted to inflation only after a considerable time lag. This is why you need to plan your pension. Belongs the losers those who rely only on their wages. Their purchasing power can only increase temporarily. In the long run, the effect of wage increases will melt away. Moreover, wage settlements typically do not precede price increases, they are usually delayed. and those who save only in cash or bank deposits. In this case, the deterioration of their money erodes its purchasing value. So although they have money left over, they don't get nearly as much for it in goods and services. You can ask, how can you protect yourself against inflation? Since inflation is nothing more than the deterioration of money, the best way to protect yourself is not to keep all your money in cash. Choose an investment that is right for you and your goals, and that can generate returns above the level of inflation. There are many options to choose from. Suitable assets include bonds, shares, investment funds that include bonds and shares, either actively or passively managed. The alternative investments can also be a good option, if you know how to handle them. These could be precious metals, collections, or even works of art. Although it is capital intensive and requires a lot of skill, you can achieve good results with real estate. If you don't want to invest in real estate and just want a share of the profits, you can choose a real estate fund. Which you are surely not be able to use for this purpose are the bank deposits and the government bonds. These tend to underperform inflation, so your money loses value. In summary, inflation is needed to keep the economy running up to a certain level, and you need to adapt to this in order to avoid problems with the value of your money falling later on. Choose an investment that produces above the level of inflation and thus allows you to grow.